Good morning, Accounting 110, the the Thursday class. And what I'm going to do for us today is take us through a review of chapter 7, 8, and 9. Now, you already have some pretty good videos, I think, up there, and your textbook and a lot of resources to study for the test. I thought I would take us through some of the more basic things, the low-hanging fruit, if you will, that will help you out come test time, okay? Accounting for cash, we know what cash is. It's money, huh? Coins, bills, checking accounts, money orders. It's direct transfers, it's wire transfers. What is internal control? Internal control means the measures that a business takes to protect its assets. For example, with cash, you want to break up the duties involved in handling cash. You don't want one person to be going to the bank with the money. You don't want that same person to be opening up the mail, also entering it into your records. It can cause temptation and theft. A good thing, bring the money to the bank every day. I bet a lot of you worked in a fast food restaurant. At the end of the day, they take that money and they put it right into the old bank nightstand, huh? How to open a checking account. Whoa, I think we know how to do that. Different types of deposits, though. I'm going to go over these very briefly because, again, this is stuff that might be on the test in the form of a multiple choice question. Deposit ticket. You have two numbers on here. You have your bank account number, which is you have your bank account number and you have the ABA number, what's called the transit ABA number. That's going to be on the right side of the check. That is a number you're going to need if you want to wire money to somebody. Okay. I want to wire money out of my account. Well, what's the ABA number? You'll need that as well. Endorsing is just signing the back of the check, right? Blank endorsement, though, protects you a little bit. A blank endorsement, you sign the back of the check, and that's really not much protection. This makes the check payable to any bearer. You get your paycheck at your desk, at your station at work, you sign it right away, you stick it in your pocket, and on the way to the bank, it falls out of your pocket. Anybody can pick that check up and have a pretty good chance to cash it. That's why we recommend a restrictive endorsement right on the back of the check. I did this for years and years, just out of a habit. Sign my name, then go for deposit only. And if I lost the check, it just means whoever picks it up, all he can do is put it into a bank. He can't really do anything with it. He can't cash it. And you can be more specific, pay to the order of a particular person. In fact, you can all practice by writing a check to me to the order of me, and I'll show you how to cash it. Okay, I'm being a wise guy. Sorry. Here's the blanket. Here's the restricted endorsement for deposit only to Maple Consulting. If I picked that check up on the street, I couldn't do anything with it. Neither would you. Boy, I bet you know more about ATM machines than I do. Writing checks. We know how to write checks. Do we know these terms though? The drawer, the drawee, okay? The payee. The payee is the person who's going to get the check. The drawer is the person who draws the check. You draw by writing in the amount. And the drawee is the bank. Again, not hard stuff, but the type of thing could be on the test, checks and check stubs. Now let's look at the bank statement because this is going to be most of what we're going to talk about in this part of the review. Look at a bank statement here, and I'm going to puff this up if I can. Oh, it won't let me zoom. How come? I wish to zoom this thing. Oh, for the love of Cecil, I can't zoom it. Anyway, what you have here is the bank statement. Lower right-hand corner, you're going to see the ending balance, and up on top, you're going to see the beginning balance, and it repeats itself up here. That's the beginning balance plus the deposits minus the deductions, checks. You are going to see all the detail, every check number and every deposit, okay? So what we're going to do with that is we're going to prepare what's called a bank reconciliation. What an important thing to do. You should be doing it with your checkbook. I should be doing it with mine. I'm willing to bet very few of you do it, and I'm guilty of not doing it very frequently, and that's not a good thing. On any day, the balance in the cash account is going to be different from the bank. It's December 31st, and we're done with work. And we have in our cash account, according to the general ledger, $5,000. Bank statement comes 3 days later, maybe January 3rd or 4th, and we open up and the bank statement says we only have $500. Is that a problem? Probably not. Probably not. Because of timing. Checks could be in the mail to the bank and the bank hasn't gotten them yet, or the bank has recorded activity we don't know about just yet. And these are called timing differences, huh? A deposit. On April 30th, we made a deposit in our general ledger, but then we didn't bring it to the bank until May 1st, and the bank statement cuts off on the 30th. So we have it in our books, not in the bank. Reconciling item. Same thing with a check we might have written, okay? So understand these terms. Deposits in transit. These are checks we received from our customers. We have recorded them into our computer system, whether it's QuickBooks or Oracle or whatever we're using. But we didn't bring it to the bank for a couple of days. And in between those dates, we received the bank statement. So the deposits are on our side in the general ledger, but the bank has no knowledge of this yet. That's one of the reasons you have differences. Outstanding checks are the same thing. They're just checks that we wrote to pay our suppliers. You paid a saleswoman who had a tiny expense of $4. She came into the building one day and she had a parking stub, I guess, and it went through your system and you cut a check to her for $4 and she put it in her wallet and kind of been walking around with it for a month. Not in the bank yet. And then there'll always be bank service charges. Also, maybe the bank collected money we don't know about. Isn't that a nice thing? Perhaps we loaned money to somebody and they made an interest payment to us. We may not know that till we look at the bank. NSF checks, non-sufficient fund, bounce checks. Somebody paid us $200. Oh, that's great. We put it into our general ledger. We think we have $200. Now the bank statement arrives and suddenly we see that's a no good check. We don't have that $200 anymore. In fact, we never did. And then you could have errors by the bank or the depositor. Believe me, it's going to be the depositor, not the bank. Although I think in this one problem we might see here, they do give you a bank error. So we're preparing a bank statement. What do? We're going to have to understand what the deposits in transit are and what the outstanding checks are. So let's see what we're doing here. We're going to start with last month's activity. We're going to look at last month's deposits in transit to see if they've cleared in the month we're now doing. In other words, we did the bank reconciliation for the end of October, and we had 2 deposits in transit. Well, they're going to hit the bank statement this month, hopefully, and we have to go back to our prior reconciliation and make sure we account for that, okay? Outstanding checks, we have to go through them one by one, and then there could be other reconciling items. So let's look quickly but efficiently, I hope, at a bank reconciliation example. So what do we have here? We have a deposit of $637.02. We put it in our checkbook on the 21st, but the bank didn't have it at the end of the month. Same thing with these 3 checks. We wrote these 3 checks, but people are walking around with these checks in their pocket. They haven't come to the bank yet. So these are 2 reconciling items right here that are going to go on what we're going to call the bank side. The bank side. And I don't know why this thing will let me zoom. I am a bit miffed that I can't zoom. But what we're looking at here, everybody, is here is the beginning balance per the bank statement. They have to give that to you. Add that deposit in transit and subtract the outstanding checks. And now we're coming up with an adjusted bank balance of 2092.33. The simple template for the bank side of the bank reconciliation is beginning balance, add deposits in transit, less outstanding checks, and you're done with that part of the reconciliation. No journal entries here. No journal entries. We're telling the bank on paper things they don't know. Let's see what else we have. I said, let's see what else we have here. Well, let's take a peek here. Uh-oh, check number 2014. When you wrote this check out, you wrote on the check, paid to the order of so-and-so $18.98. But then when you put it into the general ledger system, you put it in at a wrong number. You transpose the number. You went in at 1988. You have a 90-cent difference there. Wow, you found you have 90 cents more than you thought you did. You actually wrote the check for 1898, but you thought you wrote it for 1988. So that's going to be added back. Look at this. Maple made an ATM withdrawal on the 13th, a drawing, didn't tell us about it. The boss, the boss tends to do that. He or she went to the bank with our company card, got $100 to, go out to dinner. Didn't tell us. Now we're learning it from the bank. And we have a bounce check. Oh my goodness, a bounce check of $200. And the bank is charging us $1.20. Good gosh. So let's see what we have here. I'm so annoyed I can't pump this thing up. Okay, so we had done the bank side and we came up with an adjusted balance of 209,230. So let's see what happens here on the company side. We have a beginning balance on our ledger of 2391.23. I believe that is, huh? I believe that is. I keep talking about bumping this up. Okay, so there's our beginning balance. And remember, we found 90 cents we didn't have. We thought we spent. That's the check for 1898. We accidentally entered as 1898. Well, here is the drawing coming out $100. Here's the NSF check, and here's the bank charges. We add these items up together, and we come to 2092.31. We have reconciled. It's really as easy as that. The bank side is simply beginning plus deposits in transit less outstanding checks, okay? Here, it's the beginning plus whatever the bank tells us. The bank is telling you, hey, you guys made a 90-cent mistake. You don't know about this ATM withdrawal? Hey, here's a bounce check, and we're charging you some interest. This piece here requires journal entries because these are things we're just learning from the bank statement. So we have to prepare, we can call them adjusting entries, I guess, but just journal entries to record this missing cash set of transactions, huh? Only two kinds of items appear on a bank reconciliation require journal entries. And that would be anything the bank tells us, okay? Hey, remember that 90-cent item? Well, when we wrote that check, we credited cash and debited accounts payable. Hey, guess what? We just get to reverse that. Debit cash, credit accounts payable. Remember the drawing we have not recorded? Now we're recording it. John Maple drawing, James Maple drawing, credit cash. Here's the bounce check. Why are we debiting accounts receivable and crediting cash? Because when we deposited this money into our system, we debited cash and we credited accounts receivable to zero it out. This customer owes us the $200 again. We got to call this guy and say, hey, you gave us a bad check. What are you going to do about it? And then the bank had a small fee, okay? So that's a quick look at the bank reconciliation. Petty cash, so do some real basic fundamentals and we'll be done with this chapter in a few minutes, huh? Petty cash. This is just a It's typically, in my world, a little tiny metal box, maybe a recipe box, and it has coins and change, it has coins and bills in it. And it's used to pay very small expenses that pop up throughout the day. The mailman comes in and said, "You're short 30 cents. You have to give the guy 30 cents." Well, you're not going to tell the guy to write a purchase order and we'll back to you in 2 weeks. No, you're just going to hand him 30 cents out of petty cash. So let's talk about how we set this up. We have to take $100 from our main cash account, debit petty cash. Petty cash is a separate cash account. You're going to see on your general ledger cash, and then with the small business, the next one might be petty cash. This is a $100 petty cash account. We set it up. Once you debit petty cash, you are never going to touch petty cash again in terms of a journal entry, unless you want to turn this into a $200 petty cash box. Okay, so that's pretty easy. And typically you have these kinds of slips in there. And this guy came in, Mr. Maple, he took somebody out to lunch and he asked to be paid out of petty cash, $25.75. Okay. At the end of the month, the cash in the box plus these vouchers must add up to $200. And here they're talking about a petty cash payment record, a special multi-column record that supplements the accounting records. And they talk about replenishing the petty cash fund. You do this hopefully at the end of the month. Typically, a petty cash box should last 30 days. If you're filling up the petty cash box every 2 days, you got a problem. You either don't have enough in petty cash or you're paying things that should not be paid out of petty cash. Maybe you need a bigger petty cash fund, which is okay if you really truly need it. So at the end of the month, you replenish it. And what you have to do is debit all the expenses from the vouchers and credit cash. Credit cash, not petty cash. Here's a simple example. The month ended, the petty cash fund had $11.20 in cash. Okay, you had a $10 bill, a one, and a couple of dimes. Well, we had vouchers of 180 sitting there, those handwritten slips. 188.80 plus 11.20 is 200. Perfect. We're not over or we are not short. Okay. Take a look at the journal entry. You're going to debit, you're going to look at those vouchers, enter them into your report, which I'll show you in a moment here. And you're going to debit these expenses, credit cash for the 188.80, and off you go. You might be interested in knowing that when you set the petty cash up and replenish it, this check cash is going to be payable personally to the custodian. Usually there's one person in charge of the petty cash. All right, Johnson, you're in charge of petty cash. Here's a check payable to you, Johnson. And your responsibility is to put that $200 in that petty cash box and account for it. Petty cash, okay? What I'd like to do is briefly, and I do mean briefly, because I know we're all busy studying. I guess I don't have it. Forgive me. I was going to show you the petty cash report. That's okay. Let me get back over here. Hold on. I was going to show you the petty cash report. It's just a bunch of columns. Left side, you have your beginning balance, and you work your way down with each transaction. You'll have a column for the things that occur more frequently, postage, perhaps, deliveries. So let's get back to our lovely set of PowerPoints here. And I think I need to reshare this with you. I think I botched this up somehow. So I'm assuming you can, I don't know if you can see it or not, but I'm not taking any chances. I'm going to share it again. Share. Okay. Petty cash. Not that tough, huh? Let's talk about a cash register. A cash register. Change fund. Change fund. I know a lot of you worked in restaurants. I just know college students graduate toward working in restaurants because they're always hiring. And you've probably run cash registers. And you know that the change fund is simply the amount of money you always keep in the cash register. At the end of the day, you clean out the cash register and you record the information, but you leave maybe $200 behind. That's called the change fund, okay? It's held back every day. Look at your journal entry. Here is another new cash account called the change fund. Debit cash register, change fund, okay? It's a cash account, credit cash. Now that $200 is always going to be left in the cash register. So, as you know, you don't always agree, but let's say we're perfect. We had in the drawer at the end of the day $1,450, right? We know we had 200 to begin with. So our cash went up by 1250, it looks like. So let's put this together here. We don't looks like we're not over or short, okay? So our sales were 1250, and that was the cash increase. Perfect, huh? Perfect. But you know, if you ever worked a cash register, that doesn't happen every day. It's kind of hard to handle cash register for 4 hours or so and not have a little mistake. You know, people leave pennies behind like I'm always doing. That's going to throw you off a little bit. It's nice to get the pennies, but you know, you might overcharge a guy. You might give him an extra buck and change or shortchange a person. Hopefully not very often. So we might have too much cash or too little cash in the box. So let's go over two brief examples. Cash in the drawer. That's how much we had at the end of the day. We had $200 in there to begin with. That means that the cash should be $961, okay? Should be 961, and it should equal the cash register tape, but it does not. Now we have to account for this $2 difference. Whatever's on the cash register tape is going to be your credit to sales. Any difference between the 200 and the cash at the end is going to be your debit to cash, and the difference is going to be short. In this case, we're over, huh? Wow. Now we're short. We're short, right? Cash register. Yeah, we're short $2. So look what happened here. 1161. That is 961. That's exactly how much money the change box increased. But our cash register tape says we sold $963 worth of Italian food, or whatever the restaurant is. The difference is an account called cash short or over. It's you got to call it something, a revenue account or an expense account. I happen to be a glass half filled kind of guy. I say that that's a revenue account because when you are over, you're going to have revenues. I mean, you could have an account called cash short and then another one cash over, but I don't think anybody would do that. Here we got a big problem. We're off $1. Oh my goodness. Cash in the drawer at the end of the day, minus 200. There's our debit to cash. There's our credit to sales. Cash registrates to sales or revenues, and cash over short is going to be a credit. Cut us off here. That is the poor man's look at chapter 7. So let's now go to chapter 8. And this should not take terribly long to review because, like I say, you are all working people. Somebody in this class everybody in this class is a working person except me. I am retired, right? But I teach. Okay. Payroll. Chapter 8 is about the employee payroll processing. Employee. Chapter 9 is the employer, okay? Now, you've all seen your paycheck. You've all seen your paycheck, okay? Before we get to the paycheck, I just want to go off on a little bit of a tangent. Of course, this might be on the test in terms of what's an independent contractor. Are you an employee or an independent contractor? If you're an employee, you're an employee if you work under the direction of a boss who tells you when to go to work. He tells you how much he's going to pay you. He tells you when you're going to get paid. He tells you when you can take a break. He provides you with benefits, hopefully, and he's going to collect payroll taxes from you and turn them over to the government. That's a little work for the employer, wouldn't you say? The employer might argue, no, you're not an employee, you're an independent contractor. These are people like lawyers, accountants, real estate agents, whatever, people who are hired for a fee. They do their work on their own time using their own equipment. They work the hours they deem necessary to do the job, and they're not really under the supervision of the company that hired them. If you hire a lawyer, you don't micromanage the lawyer. He works on his own to resolve your case. And what I'm getting at real quick was we just had a proposition on the last election where money came in to promote a proposition to make Uber drivers and Lyft drivers independent contractors instead of employees. And the big money went into a victory for Uber and Lyft. Their drivers now are officially in California considered independent contractors. What this means now is if you're a Lyft driver, you have no more insurance from Lyft or Uber. You're responsible for any damages in an accident. You are without benefits. You are considered an independent contractor. And that was the big ballot initiative that won. I happen to disagree with it, but hey, that's just me. Employee earnings, okay? Salaries and wages. Typically, salaries are people who are not hourly. They get paid once a month, once a week. Wages, hourly. But the words are quite synonymous. Fair Labor Standards Act, the good old FLSA, Fair Labor Standards Act. Any employee who works over 40 hours gets time and a half automatically, all across the country. All across the country. Let's make sure we can do this simple calculation. This will go a long way in this chapter. And I guarantee in about 5 minutes, this should not be a tough chapter for you. Helen Kuzmic worked 54 hours. She makes $14 an hour, and she worked 4 hours on Sunday. She gets time and a half for any hours in excess of 8, Monday through Friday and Saturday. If she works Sunday, she gets double time. So how do we get the time and a half rate? Just multiply the normal rate by 1.5. Not that hard, huh? You make $14 an hour, time and a half. Well, half of 14 is 7. 7 and 14 is 21. Double time would just be that. So let's take a look at her gross pay. She worked 40 hours at 14. After 40 hours, you get at least time and a half. So she worked 10 hours during the week and Saturday at $21 an hour, and then 4 hours at her double rate. Gross pay, $8.82. The key thing here is know how to get these rates back to an hour, okay? What do we do, though, if it's a salaried employee and we have to do some work? Well, if it's a salaried employee, we still have to maybe go back and figure out his hourly rate or her weekly rate. So what do we have here? Linda Swanee has a salary of $2,600 a month, but she gets overtime. So we have to keep track of her hours. She gets time and a half over 40. So we have to turn her $2,600 a month into an hourly rate. How do we do it? She makes $2,600 a month, 12 months a year. Her annual base pay is $31,200. We divide it by 2,000. Well, I'm skipping ahead. We divide her annual rate by 52 weeks. So that's 600 per week. And then you divide that by 40. She makes $15 an hour. One thing I did a long time at work were prepare the factory budgets for like 3 or 4 factories around the country, and you had all these worksheets going. Whenever you annualize somebody, just divide by 2,080. 52 times 40, 52 weeks in a year times 40 hours is 2,080. So 31,200 divided by 2,080 would have been 15. But I don't think you should have a problem doing these types of conversions. So here we go. She worked 50 hours, 40 times 15. Not so tough. We're going to have deductions come out of your paycheck. Employees have to pay federal tax, probably state tax in most of this country, and FICA, Federal Insurance Contributions Act. That's your Social Security and Medicare. That's the money that I'm living on now. I get my pension, if you will, my Social Security check every month from you, the young people who are paying me now. And when you get older, hopefully the system is still rolling and you collect from future generations. So FICA has 2 parts, which we'll see, and voluntary, huh? Take home pay, net pay. I know you know what that is, okay? Federal income tax required by the feds. Withholding allowance, you may not remember this, but when you signed up for your job, your employer had you fill out a W-4 where you put down how many allowances you want. This is a way you control how much tax is taken from your paycheck. It's not a formal document that has to be exactly correct. For example, I am a single person by myself. If I wanted to, I could put down 5 exemptions on this thing. No one's going to get me unless there's some real abuse. Here's the form, W-4. Know the form. That's the one where you claim 4, in this case, 4 dependents, 4 exemptions. I don't want to say dependents, 4 allowances, okay? The more you have in this number here, the lower your taxes will be during the year. Of course, you're going to have to pay it at the end, okay? So they're just taking us here through an example on the federal tax, how to read the tax code book. This guy earned $640. How do we find out how much should come out of his check? Well, we go to Married Weekly, because they told us this man is married and he gets paid every week. Married Weekly, how much did he make? 640. Here we go, 625 to 645. He has to pay $10 in taxes. He has to pay $10. If he claimed more, he might not have to pay any. But someone like me, I'd have to pay the 45 by my 0 exemption. FICA, know the 2 parts. Social Security, that's the pension I live on now. The pension. I get a check in the mail every day from the government. Man, that makes my day, huh? And my health insurance is now under your payment. Medicare, that's part of FICA. They come out at these rates. You don't have to know these rates. Once you get on the workforce, though, the 7.65 is going to be imprinted in your brain. 7.65, 6.2 plus 1.45 equals 7.65. For every dollar you earn, 7.5 cents or so is going to come out of your pocket for these 2 items, okay? Now, here's the part where you have to do a little bit of thinking. One of these taxes, Medicare, has no limit. So the person who earned $10,000 last year pays 1.45%. The person who earned $10 million last year pays the same percentage, okay? That's called a flat tax. Social Security is called a regressive tax because the more you make, the less you pay. And that's what we want to talk about here. Everybody is going to pay 6.2% out of their paycheck for Social Security, until you earn $128,400 during the year. And I hope you all start making that kind of money pretty soon, huh? So you're paying 6.2. And then once you get to 128,400 year to date, the tax stops. So there's a maximum amount. The maximum amount would be 6.2% of 128,400. Now, why am I calling this a regressive tax? Well, if you earned $50,000 this year or 10,000, you paid 6.2%. But the person who earned $1 million is not paying anything on $971,600. So their percentage on their total is like a tiny, less than 1%. It's microscopic. You're paying 6.2. A big earner is paying much less than that overall. Voluntary deductions, 401k. If any of you have an opportunity to get into 401k, do yourself a favor, get into it, fund it to the max, collect that contribution from the employer if you can. All right, here we go. This is really what I want you to look at. You know what you're looking at here? You're looking at the journal entry to record the employee's payroll. The employee. Look at what you have here. Gross pay. You know what's another word for gross pay? Salaries and wages expense. Salaries and wages expense. In this chapter, chapter 8, employee payroll, this is the only expense the company has. The only expense. There's no employer tax expense in this chapter. It's all the employee paycheck. So gross pay equals salaries and wages expense. You would debit your gross pay, salaries and payroll expense, $640. Well, you had to pay $10 in taxes, remember from that form we just looked at? And if you do the arithmetic, 640 times 0.062 is Social Security, 640 times 0.0145. And there's a voluntary deduction where the boss says, James, are you interested in healthcare? It's going to cost you $10 a month. And hopefully you say yes. You don't say, no, that's too much for health insurance. Yes. These are called voluntary withholdings. These are all liabilities to the company. This is not the company expense. These are all going to be credited to an account I'd like you to call federal income tax, FIT. Let's call it FIT withholding. Social Security withholding, Medicare tax withholding, etc. You can call them withholding payable. The reason I don't want to use the word payable here is some of these match employers' expenses where payable is more appropriate. But these are liabilities. You're recording a company payroll. Debit, salaries and wages expense. Credit, withholding. That's not the company's money, that's your money. But the company's duty is to turn this money over to the appropriate authority. Okay, so you have all those deductions. This is net pay. That's called cash. Cash or maybe salaries payable if you're going to pay you next week. Seem pretty clear. It should. Because your paycheck, your pay stub is the journal entry to record the payroll. And here they're talking about different reports, a payroll register. And I'm not sure I want to go through this in great detail here. But the key thing to understand here are the limits. And let's see what we have here real quick. You see Social Security over here? This is called taxable earnings. This is not, these two columns here on the right are not the tax. This is the amount of income subject to the tax, okay? So we have Social Security income here. Let's start from the bottom for a reason. Harry Wiles earned $360, right? $360 this week. Year to date, how much has he earned? He's only earned $6,300. Paul has only earned 30, 31. 34, 32, 43. You get with the idea where I'm going? All of those people are nowhere near $128,400. So their entire paycheck, 900, 640, 882, is subject to the Social Security tax. Let's take a look at Sarah, the big hitter. She earned 129,400 after this week's pay. So that means not her entire check is going to be in the world of Social Security taxable. Let's see now. This payroll now, she earned 129,400, but the limit is 128,400. So only 1060 of her salary is subject to the tax, the limits. And we'll get into the limits more when we get into chapter 9 in a moment, huh? Pay your employee by check or direct deposit. Who knew? When I first got out of college, tell you one of my stupid stories. I got out of college while the Vietnam War was raging, and I got my draft notice immediately. And no one's going to hire anybody, at least not in those days, to somebody who's been drafted. And the only job I could get was unloading trucks of 100-pound bags. I did that for about 8 months. And my point is, they paid us in cash every Friday. And that was kind of cool, being handed a pay envelope with 20s and 10s in it. It was wonderful. Here's your paycheck, earnings statement, employee record. Guess what? You have to keep records for each employee. Who knew, huh? Here is one particular employee. One employee. And this person this week let's do it this week. This person earned 640 this week, 715, etc. And we must keep track of all this information. And this is Mr. Ken Istone, the guy with the $10 health insurance, right? Right here. So it just shows you the weekly activity. And then you have the journalizing of the entry. Take a look at it. That's your paycheck. You debit your paycheck. You debit the gross pay, wages, expense. You credit these withholdings. Your book calls them payables. That's not wrong. But I like the word withholding better for a lot of reasons, okay? So these are all liabilities. This minus these liabilities is your cash. That's the whole thing with a payroll journal entry, okay? And I don't think we need to look at this. Payroll records, manual, electronic. Hey, not too tough a chapter, huh? You still with me on chapter 9? It's Thursday morning, and I wanted to see who's playing tonight on the Thursday night football game, and much to my annoyance, there's no game tonight. Why is the NFL refusing to play tonight, I wonder? All right, here we go. Chapter Chapter 9. Okay, here we go. I'm not sure if that picked up. Okay, I'm assuming you can see chapter 9. Chapter 9, the last chapter we're going to do in this class, huh? Chapter 9. Now, chapter 8 was all about the employee. We learned how to record the journal entry for a payroll. And we also learned how to come up with those hourly rates. If a person gets paid $1,000 a month, you have to take 12,000 divided by 52 divided by 40. Okay. Now here we're going to talk about the payroll expense side, the payroll tax expense. There were no payroll tax expenses in the prior chapter. Those were liabilities to the company. That was money that came out of the employee paycheck. So payroll taxes, let's see what we're talking about. We're talking about 3 things. 3, really 4. 3, we are talking about FICA. And remember, that has 2 parts. It has the Social Security the pension side of it, and the Medicare, the health side. Whatever the employee had taken out of his paycheck, the employer matches. So the FICA expense for the company is going to equal the FICA withholding for the employees. If you have a big payroll and you took out $1 million in FICA from the employees' paychecks, your boss had to write a check for $2 million, bringing the total payment up to that $2 million. He's got your $1 million, which you gave him to bring over, and he has to match it, okay? Same thing with the Medicare. It's a match. Now, there are two other taxes paid only by the employer, not the employee. FUTA, SUTA, federal unemployment tax, state unemployment tax, okay? And these can add up. Let's look at the employer FICA. Remember I said you're going to get familiar with the 7.65 one day? 6.2 of that is Social Security, 1.45 is Medicare. Keep in mind the cutoff of 128,400. So let's see what we have here. Social Security. Well, we kind of looked at this before, right? Sarah was 1060. She's the only one who went over the limit. So let's see what we have here. This amount of Social Security income is taxable. Taxable. So here we go. Social Security tax, 365.61. This was 0.062 of whatever the salary was this week, except for Sarah, who went over the limit. Social Security, 6.2, Medicare, 1.45. This came out of the employee paychecks. This came out of the employee paychecks. The employer has to match that. Has to match that. Self-employment tax. I'm only going to talk about this for a few seconds. Self-employment tax means just what it means. You got your own business going, but it requires you to pay double Social Security. In other words, you're going to pay the 7.65 for the employee and the employer. Employer FUTA, F-U-T-A. F-U-T-A, okay? This has a limit of $7,000 per each employee. So you have somebody working for you, and they go to work and they make $3,500 a month. Okay, they made $3,500. Well, they're not up to the 7,000 yet, so we have to multiply 3,500 by 0.054 to come up with the appropriate FUTA, and we have to multiply by 0.006 to get the federal unemployment. Next month, they earn another $3,500. Well, they're still subject to the tax. But after that, there's no more tax on the employer. This is all employer. SUTA. In this text, the SUTA rate's 5.4 up to 7,000. Now, the unemployment rates vary wildly from company to company. Unemployment. If you have a business where there's a lot of personnel turnover, where people work for you for a while and then they leave the company and they're entitled to unemployment for whatever reason, you as a company are going to pay a lot more. But if you're a company that has a stable workforce where most of the people have been there for a while, the rates are going to be a lot lower, okay? Most states have an experience rating system, and that's what I'm talking about. If an employer has very few former employees collecting unemployment, you get a break on your taxes here. Let's take a peek at it. Taxable earnings times the appropriate rates. Social Security taxable earnings came right from the employee payroll register. This is just the company match. Companies gonna have to pay $365.31. Medicare salaries, of course, are going to be higher because there's no limit. That turned out to be $100 and a penny. And this week, 360, it looks like only a few people were involved in this FUTA, most of the people were apparently way over the 7,000 rate, okay? And they're giving, this is kind of a long-winded entry here, obtain the total. I am going to skip right to the journal entry. Look at your journal entry. You debit payroll taxes expense, okay? You don't need to break out the expense by Social Security, by Medicare. It's important to do it, though, on the payable side. And these are payables, not withholdings. So let's go back here. Here is your calculations. This was 365, 101. We add up all these four numbers, 365, 465, 468. I get about 480 in my head, something like that. There it is. Debit payroll tax expense, 487.22. Credit Social Security tax payable, Medicare payable, FUTA, SUTA. Federal unemployment tax, state unemployment tax. Once an employee earns 7,000, you do not have to pay on their behalf any more taxes, okay? FUTA and SUTA, employer only. And let's just take a look. Now, when I've taught this class a number of times here, and I love to put this question on the test. Can't really do it under the pandemic conditions now, Zoom, because you can't put too many problems on the test. But I love putting this kind of problem on the test. I'll have a question where I say, so-and-so had wages of $26,000. And what was the total cost of this person? And you have to remember that the employer pays the same thing in Social Security tax, pays the same thing in Medicare tax, and now the employer only picks up these two. So this person really cost this company $28,409. Where I really used to trip up the smart eggs in my class was I would say that this person earned $150,000 already, and they would always forget to check the limit, and they come up with the same answer. Kind of nasty on my part, I guess, but I did think that was a good problem. So the total cost to the employer is a lot more than the gross pay. He also has to pay Social Security. He also has to pay the Medicare. He may also have to pay FUTA and SUTA, okay? I remember many years ago, in one of my dumb little stories from back in the early 70s, I went to my boss. I was making like $12,000 a year. And I said to the boss, well, I had a good year. And he said, yeah, you did okay, Bob. He said, that's why we're proud to give you a raise to $12,500. And I said, gee, I was kind of hoping going up to 14. And my boss pulled this trick. He goes, oh, yeah, here's what you really cost us. And he showed me the taxes. And I felt good that I didn't have to pay him when I got done with that meeting. Employer payroll responsibilities. Yeah, you have to report all of these taxes. Don't worry about these different deposit due dates. That is information beyond the scope of what we're trying to learn here in Accounting 110, the deposits. Take a look at this simple journal entry, and we'll get done here. Simple journal entry. Well, we have to now pay these taxes to the appropriate authority. The federal income taxes, the Social Security tax, and the Medicare tax all get paid to the same entity known as the United States of America. This goes to the Treasury of the United States of America. So we credit cash and we debit these payables. Okay. 941, that's the form that you record that information. Same thing with FUTA. FUTA, you get paid that to a different agency. This goes to the Federal Unemployment Agency, and then you might have one for SUTA. Okay. SUTA, we had that payable. What's a W-2? I bet you're all familiar with the W-2. This is the tax statement you get at the end of the year. It's going to show your total wages, and it's going to show what your Medicare wages were, what your Social Security wages were. what your taxable wages were considering a 401k. And this is a form you're going to get. Your boss is going to send a copy of it to the federal government, and everyone's going to be working with it. W-3 is just the roll up. I-9, this is the eligibility forms you have to provide when you start working for a company. You have to provide them with at least a passport, not at least a passport. If you give them a passport, that's good enough. Otherwise, you have to show them a social security card and a driver's license. Now, those rules may have changed over the last 4 years, 5 years. I really don't know. I don't think so. Workers' comp. Let's just talk about this a little bit. You might find this interesting. Workers' comp insurance. This is purely an employer expense, not the employee. And it provides an insurance base for people who get hurt at work. Employer pays the entire cost. And the cost depends on the number of employees, the riskiness of the job, and the accident history. Rate is higher for a commercial fisherman compared to an office worker. I would think so, right? I think being a commercial fisherman in the middle of the ocean is more likely to drown than a guy working in an office, okay? So the nature of the business drives this a little bit. And also the experience on it. You know, if this commercial fisherman, if this company has more than the average amount of accidents, and hopefully they don't, but if they do, they're going to pay more in the next year's workers' compensation. And again, I'll end this with one of my silly asides again, if I may. A couple of years ago, I had a class, and it was a lot of international students. And I love all my students. I really get a kick out of interacting with the internationals. And I put what I thought was the very easy multiple choice question. I put down, which of these professions probably has a very high workers' comp rate? And I said a doctor, a lawyer, an accountant, or an underwater demolitions explosives expert. And would you believe people were coming up to me and they didn't know what the underwater demolition was? I ended up putting up a picture on the screen of a battleship blowing up or something. Anyway, workers' comp works this way. You have a total payroll, okay? Total payroll. You multiply it by your rate, and that becomes your expense. You do this at the beginning of the year. You debit workers' comp expense, you credit cash. And then at the end of the year, you adjust if necessary, okay? Our estimated payroll was 210. We estimate that. At the end of the year, is really 220. There's a $20 difference. Hey, we get a refund of $20. I don't think we need to know any more than that, okay? So hopefully I didn't have too many asides, too many distractions. Hopefully this will help you a little bit. Good luck. And I guess, you know where to find us for tutoring. We're all available, me and Alan and others. And I wish you good luck, everybody. Hope to see you in the future on campus. Wouldn't that be nice? We'll talk to you later. Bye-bye.